Hi guys, and welcome back to another video. Today, let's talk about the FHSA, how it works and how it can possibly help you to buy your dream home. I actually did not use the FHSA myself to purchase my first condo. Instead, I used the HBP program, or the first time homebuyer plan, simply for the reason that the FHSA did not exist yet at the time that I bought my first home. I'll explain about the HBP another time, but just so you know, the HBP allows you to withdraw money tax-free from your RRSP account to purchase a home. So the FHSA, or the First Home Savings Account, was just launched this year on April 1st, 2023. So what is an FHSA, or First Home Savings Account? It is a special savings account that is designed to help you save up for the down payment of your first home. And I want to give you some context of where the FHSA fits into. I think that's very important to understand things better. So if we go to the canada.ca website, you will see that there are a number of savings and pension plans. So there's the RRSP. I made a video about this last week. And then there's the TFSA. I'm going to make a video about that. A number of other savings plan. And then you have the First Home Savings Account, which is newly launched this year. So an FHSA is a registered plan allowing you, as a prospective first-time home buyer, very important here, and there are certain requirements to what constitutes first-time home buyer, to save for your first home tax-free, but up to certain limits. So that means that you put money into that FHSA, and if you use that amount to pay for your home, for the down payment of your home, you will not need to pay taxes on that amount, which is awesome. So yes, if the FHSA had already existed at the time when I was about to buy my first condo, I would have definitely used the FHSA. And that brings me to the benefits. So what are the benefits of opening an FHSA? The first benefit, and the greatest benefit, I would say, is the tax benefit. As I mentioned earlier, the money that you contribute to your FHSA can be deducted from your taxable income, and with that reduce your tax. So let's say that you earn $50,000, and of those $50,000, you put $5,000 into your FHSA. That means that next year during tax reporting, you will only need to be paying taxes on $45,000. So that $50,000, your income minus $5,000 that you put into your FHSA. So you will not need to pay taxes on those $5,000. Just for the sake of this example, assume a tax rate of 20%. 20% times $5,000, that is $1,000. So you are saving $1,000 immediately just by putting money into that FHSA account. But a very important note, guys. If you withdraw money from the FHSA and do not use it to purchase a home, but you use it for something else, let's say for your tuition or to buy a new car or whatever, then that tax-free benefit will not apply. In that case, you will need to pay taxes on the money that you withdraw. Another benefit of the FHSA, which is also awesome, is that if you put money into your FHSA and then invest it, and then your money grows, for example, you earn dividends or interest, that income is also tax-free. So having money in your FHSA allows your money to grow tax-free. On the contrary, you certainly know, in case you have any investment experience, that if you were to just invest your money into, let's say, a stock outside of any of these savings plan, and the value of the stock grows, and then you sell it and you make a profit, that growth, that income is subject to tax. So at this point, you might be wondering, okay, if I put money into my FHSA, what can I invest my money into? So you can invest it into most investment products, the most general ones known, such as stock, bonds, mutual funds, ETFs, and so on. So on first glance, you would say that isn't the FHSA very, very similar to the RRSP? And I would say yes, because the RRSP also has those two benefits that I just mentioned, which are the tax deductions and also the tax-free investment income. I'd say the general difference is that the RSP is more geared towards retirement, as it says registered retirement savings plan, although you can use it partially for the home buyer's plan, whereas the FHSA is set up solely for the purpose of purchasing a home, so you cannot use the money for something else if you want to enjoy the benefits. So next, let's talk about how much money you can actually contribute to your FHSA, because there are certain limits and they are pretty low, I would say. But before we go on, I want to remind you that one really important thing to do before purchasing your first home is to ensure that you build your credit. And an easy way to build your credit is to use your credit card in a responsible way. And to all you newcomers to Canada out there, I need to tell you about this really awesome credit card. And this will be especially interesting to all those of you who do not have any Canadian credit history yet or have challenges getting a regular credit card. So NEO is a Canadian financial institution that is 100% digital, and they have this awesome product, the NEO Secured Credit Card. It works like a normal credit card. The difference is that your credit limit is based on what's called your security funds. If you, for example, set aside $500 as your security funds with them, then your credit limit will be $500. And by the way, you can get started with as little as just $50, which makes this card even more accessible. And there are also 3 really awesome things about this card that will save you time and money. Even as a newcomer to Canada, you can immediately apply for NEO's secured credit card, as approval is guaranteed. No waiting until you reach a certain income level. NEO also doesn't require a credit check, so it doesn't matter if you do not have prior credit history here in Canada, although you do have to be a Canadian resident and have a Canadian ID. Another really great thing is that there are no monthly or annual fees, because why would you ever want to pay annual fees for a credit card? And you can earn an average 5% cashback at over 10,000 NEO partners across the country. Best of all, you'll even get a $25 sign-up bonus if you sign up for NEO Secured Credit Card using my affiliate link in the descriptions below. So thanks NEO for sponsoring a portion of this video. Now let's continue. How much can you contribute to your FHSA? The amount that you can contribute to your FHSA is actually called your FHSA participation room. And there's a maximum amount that you can contribute to your FHSAs or transfer from your registered retirement savings plans. So you need to stick to that maximum in order not to create what's called an excess FHSA amount. You do not want to exceed the amount because you will need to pay a penalty on that. Your FHSA participation room in the year that you open your first FHSA, so let's say you open it this year, October 2023, is $8,000. $8,000 is the maximum amount that you can put into your FHSA. But then there's also a lifetime FHSA limit, which is $40,000, so you cannot exceed that. So let's say you want to buy a property that costs $1 million and the down payment will be minimum 20% or $200,000. That obviously means that using the FHSA alone will not be enough because it caps at $40,000. So let's say you plan to put some money into your FHSA, and in the same year you also want to transfer some money from your RSP into your FHSA. There's an example here that I'll quickly summarize for you. Basically, it says here that the maximum amount that you can contribute to your FHSA is that $8,000, and that includes both your contributions as well as your transfers from your other accounts. So you cannot, for example, transfer $8,000 from your RSP and then also put $8,000 into your FHSA, because that would make $16,000, and that means that you would exceed the maximum limit. So a very simple example of what would be possible is that in year 1 you contribute $8,000, year 2 $8,000, year 3 $8,000, year 4 $8,000, year 5 $8,000, year 5. At year 5, we already arrived at $40,000, 5 times $8,000, so that will be the max, and you cannot contribute any more than that. If in any year you contribute more than that, there is a penalty on the excess, which I think is around 1% per month, if I'm not mistaken. So make sure that you do not over-contribute because there's no point in doing it. Some of you might also be wondering, okay, what if I put $7,500 into my FHSA and then it grows by $750? So the market value would be $8,250, right? Does it mean that I've exceeded my contribution room? And luckily the answer is no, because the maximum contribution is calculated based on what you put into your FHSA account, and it doesn't matter how much it grows. In other words, the growth of your investments in your FHSA does not reduce your contribution room. So first, let's talk about what happens if you participate in more than one FHSA, because yes, you can have several FHSAs with different financial institutions, in the same way that you can have RSPs with different institutions. No matter how many FHSAs you have, what's important to remember is that the combined amount of all your FHSAs cannot exceed the maximum limit. So now moving on to what happens if you do not fully use your contribution room in that year, because let's say you just didn't manage to save up enough money. Wouldn't that room go to waste? The great thing is that, very similar to the RSP, you can carry forward your unused contribution room, but there are certain limits to it. So here it says you can carry forward your unused FHSA participation room at the end of the year up to a maximum of $8,000 to use in the following year. So if this year, for example, you only contributed $5,000, then you can carry forward $3,000, so $8,000 minus $5,000, the difference, to next year. So next year, your contribution room would be $8,000 plus $3,000 equals $11,000. But going back to the maximum amount that you can carry forward. So let's say you open an account in 2023 and you made 0 contributions. You can carry the $8,000 unused contribution room to the next year, 2024. But in 2024, let's say that again, you did not contribute anything, then you cannot continue and carry forward those $8,000 to become $24,000 in 2025 and so on, because the maximum that you can carry forward is only $8,000. Okay, I know that sometimes it can be a bit confusing keeping track of how much participation room you have left and so on. At least that's the case for me with my RRSP. I keep forgetting how much I have left. So how can you know for sure what your personal contribution room is, how much you have left? You can basically check that in your NOA or your notice of assessment. In case you don't know what that is, the NOA or notice of assessment is a notice or a sort of receipt that you get after you report your taxes. So it's a confirmation that you've reported your taxes and you've paid so and so much taxes, and it will also include some information on what your contribution room for your RSP, for your TFSA, and in this case also for your FHSA is. I know this is quite a lot of detail, so guys, let me know in the comments, do you like these kinds of videos where I go into a lot of detail, or would you prefer a more high-level summary? Please do let me know in the comments. Let's go on to the next important point. Who can actually open an FHSA, you might be wondering. And there are 3 specific requirements for this. To open an FHSA, you must be a qualifying individual. You're a qualifying individual if you meet all of the following requirements, these 3 requirements, at the time the account is open. The first one is that you're at least 18 years of age. You cannot be younger than that. But you can also not be more than 71 years of age on December 31st of the year. So that was the first requirement, the age requirement. The second requirement is that you need to be a resident of Canada. And the third requirement is that you have to be a first-time home buyer. And there's a specific definition for what entails first-time home buyer. For purposes of opening an FHSA, you will be considered to be a first-time homebuyer if you did not at any time in the current calendar year before the account is open, or at any time in the preceding 4 calendar years, live in a qualifying home, or what would be a qualifying home if located in Canada as your principal place of residence, that either you owned or jointly owned, or your spouse or common law partner owned or jointly owned. So you did not at any time in the current calendar year before the account is open. So let's say you open your account in October. So in the preceding months this year, you did not own a home, and you also did not own a home in the preceding 4 calendar years. To make it simple, about 5 years. Live in a qualifying home or what would be a qualifying home if located in Canada. So this is very important. This basically means that you can not only not own a home in Canada, but also in other countries around the world within that time frame. What counts as qualifying home are single family homes, semi-detached homes, townhouses, and so on. What does not qualify is a share that only provides you with a right to tenancy. Now let's talk about how you can actually withdraw the money from your FHSA and use it. The most important part, right? Because eventually the goal of opening an FHSA is so that you get the down payment together to pay for your dream home. And here's where we get to some of the limitations. In order to enjoy the tax benefits that come from the FHSA, you need to use the money within 15 years. So to be exact, it's explained here that you will need to close your FHSA at a certain point. And that's either at the 15th anniversary of opening your first FHSA, or in case you turn 71 before those 15 years kick in, then you also need to close the account. You will also need to close your FHSA account the year following your first qualifying withdrawal. So if you withdraw some money from your FHSA this year, then the following year you will need to be closing it. But let's talk about the ideal case. In the ideal case, let's say you open an FHSA account this year, and then within 3 years you've already accumulated a portion of your down payment that you targeted, and then you withdraw all that money. To withdraw your money, you simply need to fill out a withdrawal form and give that to the financial institution who has opened the FHSA for you, and you can withdraw the money and use it for your down payment. Of course, I've never done it myself. I have not used the FHSA, but I can say from my experience with the RRSP that the process of withdrawing funds was really easy and very fast. We had our funds with Wealth Simple, and to withdraw it we just needed to fill out an online form, and within, I think, 3 to 5 business days, we already got the money. Now, let's say that for whatever reason you decided either not to purchase a home, or you didn't find a home that you want to buy and you decide to just withdraw the money. In that case, of course, you can withdraw the money, but it will no longer be tax-free. If you had, let's say, $15,000 in your FHSA and you take it out, but you don't use it for a home purchase, then you will need to pay taxes on those $15,000. Another option that you do have, which is great, is that you have the option to transfer money from your FHSA if you're not using it for a home, and transfer it to an RRSP or RRIF. If you have any property in your FHSA on or before the end of your maximum participation period, generally you can directly transfer the property on a tax-deferred basis into your RRSP or registered retirement income funds. So what do I personally think of the FHSA? I think that this account is pretty awesome. And again, if I had not bought a condo yet, and if my plan was to buy a condo in the next 2 years, then I would definitely make use of the FHSA. And I think that the FHSA will especially fulfill the needs of those people who are going for a starter home, something, let's say, in the $500,000 or $600,000. But if you're going for something more expensive, let's say $1 million, and your down payment is $200,000, then of course you can still use the FHSA, but it will only contribute to a small portion of your down payment. But hey, it's still free money. You're still saving taxes on that money. But honestly, thinking about it, guys, the FHSA would only help me up to a certain limit, because we, my husband and I, we saved up for our down payment for this condo that I'm now recording in within about 2 years. Whereas, as you now know, the maximum contribution limit for the FHSA within 2 years is only $16,000. And $16,000 would be really far off from the amount that we would need for the down payment of this unit. But actually, guys, there's also a third option. You do not need to choose just between the FHSA and RRSP. You can actually use a combination of both. And it's pretty well explained on this website here, Scotiabank website. Can you use FHSA and HBP together to buy a home? And the answer is yes. You are able to, if eligible of course, combine funds from the FHSA and HBP for the same qualifying home purchase. Taking advantage of both can help you save for a down payment. Yeah, so guys, tell me in the comments, have you opened an FHSA yet? If no, why not? Or are you planning to? I would really love to hear from you. If you want to get more videos from me on how to get financially ahead in Canada while still enjoying life, make sure that you subscribe to my channel. And also while you're at it, make sure you hit the little notification bell so that YouTube will actually notify you every time there's a new video from me. Enjoy the rest of the summer. It still feels kind of summerish, I think, at least, and see you next time. Bye.